It's August of 2022. Interest rates have gone up significantly and they continue to rise. And I just got a brand new mortgage. And in this video, I'm going to show you the exact mortgage that we chose and why we chose it. That's right, you're going to get an insight into how two mortgage professionals choose their mortgage for themselves. And in a market where we can choose any mortgage that we want, I think you're going to be surprised with the mortgage that we chose, especially considering that interest rates continue to rise. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so welcome back to the channel. Today, I'm going to discuss how my wife and I, who is also one of the top mortgage professionals in Canada, in fact, she's in the top 5% of all mortgage professionals in the country, chose our mortgage. And I think how we chose it is going to surprise you, especially because most people think that when you choose a mortgage, you should be focused on interest rate and the type of rate that you get. And yes, those are part of the equation, but in today's video, I'm going to show you what's more important and why we choose the mortgages that we do and why we continue to encourage people to get adjustable rate mortgages, or in other words, a variable rate mortgage with a payment that adjusts. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And by the way, if you're in the process of buying a home, I encourage you to stay till the very end, because for those of you who are thinking about entering the market, I know it's a tough decision right now, and I've got something that will hopefully help you make that decision in the future. Okay, so let's get into it. Let's discuss how my wife and I chose our mortgage. And I think, like I said, you're going to be surprised with the mortgage that we chose. And as you can see in today's video, we've got a little bit of a different look. I've got my consumer hat on today because I want to take you through the steps that we went through when choosing our mortgage. And this is the steps that we've gone through every single time we have chosen a mortgage since we have met. And it is all about risk, but not necessarily risk in the way that you may think. Because here's what most people think of when they think of risk when it comes to mortgages. They think of variable rates and the chances that my rate may go up. And to most people, that is the single biggest risk that they think they're going to face. It is higher interest rates, but it is not. There are other things that pose a significantly bigger risk when it comes to choosing a mortgage. Things like payout penalties, the ability to switch to a different lender if you don't like the one that you've chosen, and being able to refinance. And those things all play a pretty important role when you're choosing your mortgage. And one of the biggest criticisms that I've faced with respect to my recommendations for adjustable rate mortgages over the last couple of years is that I was wrong on interest rates. And yes, I was wrong on interest rates. Interest rates went up substantially more than anybody expected, including the governor of the Bank of Canada, Tiff Macklem, who said interest rates would remain incredibly low until the end of 2023. And in hindsight, if we had been given the choice between fixed and variable, and it was only about fixed versus variable, it turns out that fixed probably would have been a better short-term choice. But there was more to it than just the risk of rising interest rates when it came to choosing mortgages. And I'm going to tell you a little bit more about that in a minute. But here's the thing that you have to understand is that rising interest rates is only part of the risk associated with choosing a mortgage. Those penalties, those restrictions, those play an important role as well. And for most people, I would rather have a conversation about the fact that my payments went up by $300 or $500 a month over the course of a 6 to 12 month period than have a conversation 2 years to 5 years down the road about how significant a penalty is and how it's preventing somebody from being able to sell their home. And those penalties I'm talking about are the ones that come along with fixed rate mortgages. Because even to this day, with interest rates rising substantially, we're still seeing astronomically high payout penalties with some of the big banks because of how those penalties are calculated. That's right. Interest rate differentials are probably one of the single biggest risks when it comes to your mortgage. And we're talking $30, $50, $70, $100,000. These are the sizes of penalties that we've seen on fixed rate mortgages over the years because of how they are calculated. So when we are choosing a mortgage and when we are helping clients choose a mortgage, yes, the first thing that most people come to us and want to talk about is variable versus fixed, but there's significantly more to it than that. And the things that we need to talk about are the likelihood of still being in a home 5 years down the road. And the statistic is that 60% of people won't make it till the end of their 5-year term. And you're thinking, whoa, who buys a house and doesn't live in it for at least 5 years or doesn't at least hold a mortgage for 5 years? And the answer is life happens, and a lot of people end up not making it to the end of that 5-year term. A lot of people are able to refinance into lower interest rates. A lot of people end up having to refinance to maybe pay for a renovation to the house or a roof that failed or any other number of unexpected expenses. On top of that, many people find themselves in divorce or separation situations where they end up having to sell the home or refinance to buy somebody else out. And it just turns out that there's a lot of reason that people don't make it to the end of a 5-year term. And for the most part, what we found in our careers is that the risk, so 60% of people don't make it to the end of the 5-year term, far outweighs the risk of a really big interest rate hike. Because think about this. Interest rates have gone up as much as they've gone up in the last 3 to 6 months, only one other time in memorable history, which was in the late 70s, early 80s, when they tried to kill inflation the last time. So for the most part, there's a very low chance of seeing a big interest rate spike, at least as big as what we've seen right now. Oh, and by the way, in the case of the mortgages that were qualified for in the last couple of years, almost everybody has qualified at a significantly higher interest rate than what is on the actual contract of the mortgage. And most people, whether they believe it or not, can withstand the rising interest rate costs that have come along with higher interest rates. They might have to change their lifestyle, but they've qualified for pretty close to the interest rates that they're at right now. Now compare that with maybe a $30 or $50 or $100,000 payout penalty that could have potentially happened if somebody had chosen a fixed rate mortgage. And those things can be potentially devastating, especially if you lost a ton of value in your property and you go to sell it and all of a sudden you've got this really big penalty that you need to pay out and you are so far underwater that you've lost all of your equity in its entirety. So there's this risk-based conversation that we have to have. And the single most important factor when we have that conversation is when we sit a couple down across the table from us and we ask them, would you like fixed or variable? Is if one person seems like they're going to be very, very stressed by having a variable rate, we usually encourage them to go fixed because the number one cause of divorce in North America is financially related. So we want to make sure that a couple can withstand the pressures of increased interest rates. And usually that means a fixed rate for those people. By the way, when clients came to us in the last couple of years and they said, we want to get a mortgage, we didn't just say, hey, you should get an adjustable rate or a variable rate mortgage. We actually asked them a lot of questions with respect to the risk tolerance and then made recommendations based on that. And if they had low risk tolerance, then we made sure that they were in a fixed rate mortgage. So it really is a risk-based conversation when it comes to getting a mortgage. Now, for my wife and I, this is how we chose our most recent mortgage. Yes, we chose an adjustable rate mortgage. The reason why is multifold. First and foremost, we never have to worry about the amortization not being the amortization that we expected. The payments will adjust as interest rates go up or as interest rates come back down. And we know from a long-term perspective, maybe not a short-term perspective, but from a long-term perspective, adjustable rate mortgages end up outperforming fixed rate mortgages even in times where interest rates are increasing. So in other words, what that means is when the Bank of Canada realizes that they increase interest rates by too much, and maybe that's a year or two down the road, they're going to bring it back down. And at some point, there's going to be some averaging out of the added interest that we've paid over the last couple of years. And we are therefore probably going to find ourselves over the long term, so I'm talking 18, 25 years here, in a net better position by having a variable adjustable rate mortgage than we would have if we had a fixed rate mortgage. Now, the other thing to consider is that the property that we are putting the mortgage on is a rental property. Now, we would have chosen a adjustable rate mortgage even if it was for our personal residence, but this property just happened to be a rental property. And in the case of rental properties, because there is a chance as an investment that we may want to sell it at some point to cash out the money for a better opportunity, or maybe because the investment isn't making sense anymore, we wanted to make sure that we minimized our payout penalty risk. So in other words, we'd rather have a 3-month interest penalty than be exposed to a potential 5-year fixed penalty or an interest rate differential and end up having to give a whole bunch of our equity back to the bank because we chose the wrong mortgage for an investment. Now, the other thing that we considered was whether or not we thought there was going to be an opportunity to refinance into a lower rate in the future. And the answer to that was a resounding yes. We do believe that variable rate discounts are going to get higher at some point, which means there is probably going to be an opportunity for savings somewhere down the road. So all of these things combined, first and foremost, wanting to avoid that payout penalty risk. Second, knowing that as an investment, we want to be able to make sure that we were liquid on the mortgage and able to get out of it. And then third, knowing that our payments would adjust gradually over time, which by the way, makes it really easy for us to indicate whether or not a rental property is still a good idea and makes sense as an investment, because if those costs go up so high that the rents are no longer covering it, that's usually a pretty good case that it's time to offload that property. And all of that combined made it clear to us that the adjustable rate mortgage was the right option for us. Plus, we don't worry about interest rates going up because we know that we've qualified at a significantly higher interest rate than what we're actually paying. We know that we can cover those costs ourselves. And we also know that if we really needed to, we could pull back our lifestyle pretty significantly in order to make sure that we can make the payments for not just our personal residence, but the other properties that we own. And here's the thing, the single biggest factor when it comes to being able to afford your mortgage and knowing that you can afford it in the long run isn't necessarily how much you qualify for and what your payments are or interest rates are. It's actually your fallback position. And what I mean by your fallback position is how much money you've got available to you should you lose a job, should interest rates go up, should you need excess funds. That is the single biggest factor when it comes to saving yourself from a foreclosure. So all of these people who bought in the last couple of years, whether they bought with fixed rates or variable rates, it doesn't really matter what type of mortgage they got. What matters is that they have a fallback position. And a lot of people in the last couple of years have bought without a fallback position. And those are the people that are going to find themselves in trouble. Yes, there's going to be some people who had rising interest rates that are going to find themselves feeling a little bit of pain when it comes to their mortgage. However, if they have a fallback position, so that means access to cash or equity or other things that can get them through a storm, then they're probably going to be just fine. And the sad thing is that's the piece of advice that people don't get, because everyone who got a mortgage in the last couple of years had to go through an advisor. They didn't just go on YouTube, watch a video, and then go online and make a decision without having any sort of consult. Pretty much everybody had to go through a mortgage advisor of some kind, whether it was with the bank, whether it was with a mortgage brokerage, or even if it was with one of the online brokerages. So everybody had an advisor in the last couple of years. And what those advisors should have been doing was looking at the risk profile of the clients and making sure that those clients were in the right mortgage for them at that time, because it all comes down to risk. So yes, we still are choosing adjustable rate mortgages for our own mortgages because we're buying with the long term in mind. We know that over the long term, we're still going to end up better off, even though short term we're losing right now. And it all comes down to just being able to make sure that we can get out of the mortgage whenever we want to, so that we don't end up giving a ton of equity to our bank. Now, at the beginning of this video, I talked about the fact that I have a solution that we've prepared for people who are looking at getting into the housing market, because I feel really, really bad for people in the last couple of years who have bought and not had proper advice. You just had maybe a real estate agent who said, buy, do it now. Maybe somebody didn't say, hey, it's a little crazy out there. Maybe you want to slow down and not necessarily buy a property. And I definitely don't envy the people who are facing that decision of, do I buy now, as the market's coming down and seemingly collapsing. By the way, I don't think the market is collapsing. I do think there's going to be some buying opportunities and some reduced values, but how much the market falls isn't the most important thing over the next couple of years. The most important thing is going to be being educated about the process. And that doesn't just mean relying on your realtor, your mortgage broker, your family member, the comment section of YouTube, or even a video like this that goes over a very small piece of information in a small piece of time. What matters is that you have the information that you need in order to make an informed decision. And I've looked all over the internet, I've looked at all the books, I've looked at all the research, and what I realized is that there's so much information out there, but to get it all in a concise package that allows you to go through and make a purchasing decision in an informed manner is really hard. So what I did is I've read all the books for you. I've taken all the classes. I've run a real estate company. I obviously run a mortgage brokerage now. And I've taken all the information from a combined 19 years of experience, and I've put it into what we're calling the Home Buyer Masterclass. And this masterclass is designed to make it so that you can make an informed decision that isn't going to cost you a ton of money down the road, because I want to make sure that people have the information that they need in order to make a decision. Because if you watched a whole bunch of the videos from the last 2 years, one of the biggest things I was telling people is don't buy in the crazy market. This craziness is going to end. Crazy markets tend to last 3 to 9 months, and then they go the other direction. And people just weren't hearing that because of the shortness of the video. So what I've done is I've put together this modular course that gives you all the information you need, no matter where you're at in the process. So if you're early, just saving a down payment, it's got all the information you need there. When it comes to choosing a realtor, it's got all the information you need there. By the way, it's got the #1 question that you should be asking every single realtor when you go to hire them. I talk about how to get a mortgage, talk about how to choose the right mortgage broker. We talk about the closing process, the home inspection process, and no matter where you are, you'll be able to go to the module that applies to where you are right now and get the information you need in a timely fashion. Now, what we've done is we've put this course together in cohorts. Anybody who takes it right now is going to be in the founding cohort. So you're going to be the first to get access to the information, and any updates we make in the future, you will automatically get. But What this is going to do, no matter where you are, whether you're buying in the next month or you're 3 months out or 6 months out or 2 years or 5 years, you're always going to have access to the information you need for the phase of the buying process that you're in. And what we've done is we've priced this course super, super low. It's 3 payments of $47 if you buy today. If you don't buy today, that's okay. You can still get early bird pricing up till the end of August 31st. And if you don't get it by August 31st, the last day to register for this first cohort will be September 11th, because we'll start on September 12th, going through all of the information. There's going to be a great group of people who are going through it with you. There's going to be a support group there so that you can share ideas. And one thing that you'll be able to get that nobody else can get unless you're getting a mortgage through Mortgage 360 is you'll be able to get at least 15 minutes of one-on-one consultation with me. That's something that we're not doing in any other circumstance, at least until 2023, because of how busy we are at the moment. Oh, and if you do decide to get a mortgage through Mortgage 360, depending on when you sign up, you'll get between $1,000 and $1,500 in a credit that you can use for a rate buy down or for legal fees or for moving fees or whatever you want to use. So it's a win-win situation because you're going to be paying $47 times 3 payments, and you're going to get at least $1,000 to $1,500 back, assuming that you use us for your mortgage. So we put this together because I care about the people on this channel. I don't want to see people make bad decisions. There's a lot of people who made bad decisions on variable rates because they didn't have the full picture of what they needed to know. They watched a 12-minute video, and I don't want that to be any of you. So I want you to have the resources that you need in order to succeed. If you want to sign up, go to homebuyermasterclass.ca, and we'll start on September 20th. Oh, and by the way, like on every other video, if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video, and we'll see you on the very next one.